The Bank of Canada brushed off questions about rate cuts as it held its policy rate at 5% today, arguing inflation is still too high to justify lower borrowing costs. Manisa Dadabolan joins us live in studio with more on this. Hi there, Manisa.
Hey, Taz. Governor Tiff Macklem, who held a press conference after the announcement today, acknowledged that inflation has continued to ease and the economy is weakening. He faced a barrage of questions from journalists on when the central bank might pivot to rate cuts. But Macklem held the line. Higher interest rates have helped slow the pace of price growth by causing a pullback in spending in the economy. Canada's inflation rate dropped to 2.9% in January, falling back within the Bank of Canada's 1 to 3% target range. However, rapidly rising housing costs are standing in the way of getting inflation down even lower. In January, shelter prices were 6.2% higher than they were a year ago.
In the 6 weeks since our January decision, there have been no big surprises. Economic growth has remained weak and inflation has eased further as higher interest rates restrain demand and relieve price pressures. But with inflation still close to 3% and underlying inflationary pressures persisting, the assessment of the Governing Council is that we need to give higher interest rates more time to do their work.
While today's decision is no surprise, economists are doubling down on their expectation that the first rate cut might come in June because they expect the Canadian economy to weaken further. Taz?